We're here to talk about Silicon Valley real estate market for October the 12th. These are the slides that we're going to be going over, grouped in chapters, so you can jump to each one of these. First, we're starting off with the key market indicators over the past 14 weeks. Then we look at the 3 indicators over the past 10 years. Then we break down and look at Silicon Valley as a whole compared to a hot marketplace in the red, a cool marketplace in the blue, typical in the gray, and the purple being the raw data. Then we look at 3 distributions where you look at weekly distributions, and I jump forward at 4 or 5 weeks to simulate a month at a time. And you look at days on market, ask price reductions, and buyer overbidding. Then you come down and look at the 3 counties that make up Silicon Valley and seeing what the data is like over the past 10 years. Then we get into the micro market data for Silicon Valley, the 3 counties, the summary table, the raw data, the low number of offers. And then we get into the introduction of how to participate. Then you get into the Greater Bay Area, which is 5 regions, 13 counties. And then I present that data only based on the individual 5 regions over the past 10 years. And finally, that raw data. So let's jump into the information. Here's the first data slide. What we're doing here is we're comparing normal, which is the gray line, to the current line, which is the purple line. The red line is the hottest the indicator has ever been. And that's based on the 10 percentile. Or the 90 percentile, and then the blue line is the coolest you'd expect the market to be, which would also be the 10 or 90 percentile. On inventory, high inventory, 90 percentile would be a cool marketplace. The median for the past 10 years would be where you'd expect the market to be, and the purple is where the market is actually today. What we're doing is we're going back a full quarter and a bookend, so 14 weeks. And 14 weeks ago, we were at 84% of the level of inventory you'd expect, so missing 16% of the market. Now you're at 90%. So we've gained 6% of the market, but we're still missing 10. And we've gained 150 listings roughly. Normally the market would be going up at this time of the year. From 14 weeks ago, it's actually gone up a little bit. You can see the level here is lower than the level on the right-hand side. So the level at the left side, all these left side numbers are where we were 14 weeks ago. The numbers on the right side are where we are now. So inventory typically goes up from 14 weeks ago. Inventory, what confused me a little bit there was the inventory is normally going down at this time of the year, but you can see that it peaks right about here, which is not quite 14 weeks ago. It's 13, 12, 11 weeks ago, sort of typically where the peak of the marketplace is. And frankly, this year is one of the later peaks in the marketplace, and we hit it about 2 weeks ago. In some areas, it's still going up, and most of the areas it is coming down. Moving on to offers accepted. Now, high number of offers is a hot marketplace because there's a lot of buyers competing. And the gray line, again, is the typical. The blue line is the least you'd expect. And you can see we've been at or below the least offers you'd expect until just 2 weeks ago. 2 weeks ago, we crossed over, and now we've been above, and we have a marked divergence here. Normally, you can see from the blue line, the inventory on the low end is normally going down. On the normal marketplace, the gray line, it is got a slight up tendency right now for the last 4 weeks. Obviously, it was higher on the left-hand side of the graph. You know, this number up here is higher than this value here. And, you know, the low point in the recent 14 weeks is what, 4 weeks ago, right here. And that's probably associated with Labor Day. But anyway, you can see that the offers is going up. And especially this last week, I would say it's going up more rapidly than it typically goes up. So in other words, there's a little bit of a surge after Labor Day where you have this slight increase. And I would say this increase started a week earlier and has been going up at a slightly higher rate than it normally has. We're climbing, and we've gone from 73% of the offers you'd expect to 86%. So on the offers, you've gained basically 13 percentage points of the market back, which is good for the industry. It means more transactions. Then the DUI is the seller-buyer balance, and this is the turnover ratio. And you can see that we started off the quarter, and this is a moving quarter, not a calendar quarter, at 15% above or slower than you normally are, which is why you're above the gray line. We basically came down to the gray line right around Labor Day. We did a little divergence, and now we're on the low side. So we're actually a little bit hotter now than you'd expect, and you can see that in the percentage. We're at 93% of where you'd expect days unsold inventory to be. So we're 7% faster than you'd expect, even though the number, the raw count is 47. So 47 is actually a high number for Santa Clara County, even though I consider 40 to 80 to sort of be the balanced marketplace. typically Silicon Valley is in a fairly hot marketplace. So even though this is lower than where it typically is at this time of the year, we're slower than we typically are, but we're faster than we normally are, if that makes any sense. In other words, the buyers should feel less pressure on a basis, but it's more pressure than they normally feel at this time of the year. Moving on to time to sell, days on market, the 75th percentile. This is for the people out there that don't like statisticians like myself playing around with the numbers. Simply, how long is it taking 3/4 of the sellers to sell their properties? You can see we started off the quarter at 23 days, which was 25% higher than it normally is. And then you can see that we came down, we narrowed, and between 2 weeks ago and last week, we were basically right where you'd expect it to be. And this week we're on the low side. So we're only taking 93% of the time that we normally take to sell, and that's 25 days. So notice that even though the market's improved something like 32%, so almost a third of an improvement in the marketplace, the time has actually slowed down. So sellers are taking longer. They took 23 days 14 weeks ago. They're now taking 25 days, even though we went from 25%, 24% slower than normal to now 8% faster than normal. Moving on to ask price cuts, and these are from when the listing goes on the market. I try to delete out data entry errors and those kinds of things, but it's a measure of the seller's expectation to market realities. In other words, I believe the vast majority of the sellers do their homework before they put the property on the marketplace. And if they're asking a price that's too high for the marketplace, that would say that their expectation, their reading of the marketplace was overly optimistic compared to where the market really was. So again, starting 14 weeks ago, we were at 0.9% price reductions. Now, again, that may sound like a very small number, but remember the vast majority of the sellers do that homework and don't do any price reductions. So this 0.9% price reduction is probably something like 15% of the sellers taking something like a 8% price cut. And that's actually 17% or almost 18% more price reductions than normal, which is why the purple line is on the blue side of the gray line. You can see that we went along the quarter pretty uneventful, but again, in just the last week or two, we've come up and we're right at the normal level, and you're at 100.5%. So 1/2%, that's 0.5% more price reductions than there normally is. And that's why if you look real carefully, the gray line is just above the purple. They look like they're right on top of one another, but the gray line is just ever so slightly above that purple line. And being that the purple line therefore is on the blue side, it is taking greater price reductions, and that's why you're at 100.5% of the price reductions. Overbidding is going to be a lagging indicator because we have to wait for the buyers to escrows to close, and that's a longer lagging time when the market is slow because buyers don't feel they need to be aggressive with their quick closes. So you started off at 0.4% greater price overbidding than normal. So normally the price overbid a quarter ago was 6.8%. Now, even though we're down at 6.1%, that's a full 1.5% higher than normal. So normally you're at 4.6% overbidding, and now instead we're at 6.1%. And this is the average overbid, not the median overbid, which I also track in different slides. So that's a little confusing. You can see that you're quite a bit above the gray line. And this actually started several weeks ago. This started about 8 weeks ago, it looks like, where you started to be above the gray line. And keep in mind, this is a lagging indicator. So this is not really where the market is today, but this is where the closings are that were negotiated basically mostly 5 weeks ago. So there's about a 5-week lag time. Moving on now, and here you get to see the data going all the way back to 2014. And what I'm doing here is I'm plotting the 3 key things: inventory, offers, and the days of unsold inventory, which is a sort of a measure of the turnover rate or the speed of the marketplace, to the black line, which is their individual 100% of normal level. What you're seeing here is the inventory, the purple line, is 90% of the inventory you'd expect. And look at the increase that you have seen in about the last 7 weeks. We went from basically 78% of the inventory you'd expect all the way up to 90% of the inventory you'd expect. So there's still a shortage of inventory, but degree of shortage is becoming smaller. Looking at the offers, they didn't turn around 14 weeks ago, but they turned around close to about 6 weeks ago, probably right around Labor Day. And look how that shot up. So it's gone from about 72.5% of the offers you'd expect all the way up here to 86% of the offers you'd expect. And then the speed of the marketplace measured by days of unsold inventory has come down dramatically This is the Labor Day fluctuation. Every holiday tends to do this because sellers don't come on the market the weekend before, where buyers are still looking. The weekend after, the inventory floods the marketplace and buyers haven't had an opportunity to buy it. So there's this weird heartbeat fluctuation with every major holiday. But look at the, and so even if you come down to something like here, look at the improvement you've gone. You've probably gone from something about 107% down to something like 93%. So now you're actually faster than you typically are. And for those that are paying strict attention, if you look at the inventory being above the level of offers, you'd expect the market to be slower because there's more inventory than there are offers instead of faster. Well, the reason that you can have this parent discrepancy is each metric is looked individually. And when I dove into this to make sure my data was correct, the offers accepted, the inventory accepted, and the DUI all are using different years for their median. So you take each one of their medians and you look at the median for the past 10 years, they're occurring in different years. And that's why this is below 100%. So the market's faster than it normally is, even though based on the two inputs, the inventory in the purple and the offers in the orange, you'd expect it to be of 100%. So just clarifying that for anyone that notices that on their own. Looking into active inventory. So now we're going to look at each component and we're going back over here. And this slide is a little goofed off up on the left-hand side. So I apologize for that. Oh, it's actually slid. So you have to, this is a photo overlay so that I can do a condensed version. So this whole photograph should be slid back from there to right there. Basically, this is where you are. Basically, what I'm doing is I'm doing a condensed slide from 2014 to January 1st, 2023, superimposing it on a more spread out slide. The more spread out slide is supposed to give you the entire year of 2023, and part of it's being blocked. And then the current year on the blown out scale, so you can see trends and you can see the impact of Labor Day, you can see the impact of July the 4th. But the big takeaways on the slide are the gray line is the slope that you expect the data to be doing. The purple is what it's actually doing. The red would be a red hot marketplace, a lack of inventory. Blue would be a surplus of inventory. You can see at the beginning part of this year, we had a lack of inventory. Basically, second quarter, we turned around and cured most of that lack of inventory. We were still on the low side, but as we saw from the data, not as bad as we were earlier in the year. And now we have rolled over. It looks like an inventory is going down. So this is for Silicon Valley. This is Santa Clara County, San Mateo County, and Alameda County. Some of the other counties that we talk about, especially in the 13 counties, those inventories are still actually going up. Now what we do is we take the actual data slide and just stretch it out. We stretch the gray line out instead of it going up and down, showing the level of inventory. We call that 100%. And we're comparing the purple line to that 100% mark. And right now you can see inventory is basically at 90% of the inventory you'd expect it to be. Here's the slide actually done correctly. But you can see we start back here on January 1st, 2014. You got 9 years of data on this condensed version. Then you have 1 full year of it expanded out. And then you have the current year also expanded out. You can see the data currently is going up. So you're getting more offers accepted. And noteworthy is you have this normal run up. If you compare the slope of the purple line to the gray line, it's very similar. You have a huge run up at the first quarter and a half of the year, and then you come sliding down until basically Labor Day, and then you slide up until about the middle of October, and then around the middle of October, you start crashing down for Thanksgiving and the end of the year holidays. So Halloween comes right about here, which is already cooling off a little bit, and then it really dies off for those other major holidays. We're again pulling out the gray line, the curvy gray line on the previous slide, making it straight, and you're seeing what the inventory is doing. So even though the inventory was fluctuating a lot, it was running basically right around 70% of the level you'd expect it to be, starting in halfway through third quarter, which would be somewhere around, well, fourth quarter starts October 1st. So this is basically Labor Day. This little fluctuation is probably Labor Day exactly. You can see that the number of offers on a percentage basis have gone up. We've gone from something like 74% of the offers you'd expect to 86% of the offers you'd expect. So a huge improvement in just the last couple of weeks. Here's the days of unsold inventory. You can see the purple line is almost right on top of the gray line. You'd have to argue where we are, but I would say we're a little bit below. So you're a little bit on the hot side, but pretty close to a typical marketplace. I would say as far as the speed of the marketplace, it's been following the gray pattern, but a little bit shifted up towards the blue, which would be a cool marketplace. Now basically just before October 1st, it did this huge improvement, right? Probably at Labor Day. And now it's basically following the normal marketplace. So you have a days unsold inventory, a turnover rate that's basically normal. Here's again pulling out the normal line, and you can see that you had this huge improvement. And even if you take out the holiday bounce, you've gone from something about 107% of where you'd expect days unsold inventory to be to down here to somewhere around 93%. Fairly significant improvement in the marketplace in the last 3 weeks. Here's the marketing time. 75% of the sellers are selling their property. They're now selling it in 25 days, which is pretty quick. That's under a month. It's now below the gray line, which is the typical. So typically you'd expect marketing time to be increasing as seen by the upward slope of the gray line. But the purple line, the actual raw data, has been basically going fairly significantly down. We're taking less and less time to market properties at a time of the year where you're normally taking longer and longer. Clearly, we're not really following the normal pattern of the marketplace currently for the last 3 or 4 weeks. Here's days on market, and you can see the huge improvement. Again, taking care of the Labor Day bounce and bring that down to maybe 111%. And now you're down to something like 92%. So you've improved basically somewhere around 20%. It's taking the sellers 20% less time, and that's 20% of the normal time less than it normally did. They were going from 10% above the normal time to 12% above the normal time to 8% below the normal time. So what I'm doing on this slide is acknowledging, and it's something that you typically don't do in statistics. You normally ignore your outliers. But what I'm saying is the vast majority of the sellers don't do any price reductions at all. So I'm going to ignore them and only look at the 10% of the sellers that are taking the biggest price reductions and plotting that number. So normally sellers are taking somewhere around an 11% price reductions. The 10% of the sellers that take the biggest price reduction, that average is 10%. Well, now we're at a little bit higher than that. We're down here about 13% of a price reductions. And here again, you stretch out the gray line. And the reason the gray line is not at 100% is typically sellers are doing somewhat of a reduction. I'm not plotting this compared to the 10-year median. Here you can see that sellers are taking 20% larger price reductions than they normally do. We're not taking a 20% price reduction, but the 13% price reduction that we're taking is 20% bigger. So this is the typical. So that line should be shifted up. So I apologize for misgraphing that. Here's the actual raw numbers. Here you can see that the gray line here is at 100%, 0% reduction. The red line is the hot market price, which are very small price reductions. And this is flipping back over to the average. I'm doing the average because average is far more common. I don't want people to accuse me of playing around with the data. The gray line is where you expect it to be. And we've gone from greater than normal price reductions to right on top this last week. So it's going to be interesting. And it looks like we'll be quite a bit above than where the market normally is. And you can also see that the market sometimes improves going into the holidays, where people are anticipating the prices for the next year to come through, and they actually start appreciating some, and that results in lower price reductions because the market catches up to those sellers that were priced a little too high. Here's the average overbid where I'm pulling down the red shaded area below 100%. So even though a small price reduction would be a red hot marketplace for the average seller, and it's a fairly small number because 1% is all the way down here. So it's basically about a third of 1% price reduction. And here you can see that we're down just a little bit over a 1% price reduction, which is again averaged over. So a large number of the sellers are doing no price reduction, which is why it's such a small number when 10% of the sellers are taking that 13% price reduction that we saw earlier. Here's the frequency. So how common is price reductions? So right now you're about 15.5% of the sellers are doing price reductions. Normally that's up at 17%. So it's normally a larger number of sellers are doing price reductions. So since fewer sellers are doing price reductions than normal, you're on the red side, the hot side of that gray line. Here you are where this is 100% of the sellers doing price reductions. You can see that you're greater. You're down here at about 83%. So 17% fewer sellers are doing price reductions. Here's the median overbid. So we're flipping over now. And keep in mind, this is a lagging indicator. So this is where the market was 5 weeks ago. The gray line is the where you expect the market to be. The blue is the coolest you'd expect it to be, the least overbidding, and the red is the most overbidding you'd expect. So we're in between the gray and the red. So you're slightly hotter than the market than you normally are, and you're somewhere right around 3%. And this is the median. So that's why this number is at 3%, and the numbers before were up around 5 to 7%. Pulling it out, you can see that we started off about midway through the third quarter. We started this fairly significant run up in overbidding. Basically, the magnitude of overbidding increased right after Labor Day. Here's the frequency of overbidding, and the frequency really didn't change until this last week, and it's hard to see if it's an increase. But also notice that the gray line does the same uptakes. So you got to keep that in mind. For whatever reason, at this time of the year, the market normally does a 1-2 week correction before coming back down. So it's going to be interesting to see where next week is, but I would expect it to be close to flat. Here's the frequency, and you can see the frequency is a little bit more common. So it's a hot marketplace with more common overbidding by buyers would be a hotter marketplace, and you're basically 2% above where you'd expect it to be. Again, very close. You know, the white area here is sort of the range that I would call a typical marketplace. Here's your long-term appreciation shown by the blue diagonal upslope line. The purple's the actual data. The real takeaway, in my opinion, on this slide is to point out that when you time your marketplace does matter, and it depends on what you're looking at, but the median price of the home is definitely lower at the end of the year. And remember, it takes 5 weeks to do it. So even though this is getting reported out somewhere around the middle of January, that was activity 5 weeks earlier, which is basically the first week in December, sort of the low price point for negotiations. And then the same thing here, the high price peak is basically 5 weeks earlier than about the middle of second quarter. So right around the end of first quarter is when prices are the highest. Now, keep in mind, what I have noticed is not only is the property values don't swing this much. What's happening to some degree is the type of properties and the location of the property swings, the market mix swings, that causes some of this perturbation to be more exaggerated than it typically really is. Here's the estimated payments for the most expensive home in Silicon Valley at $25,000 a month. The median priced home is somewhere around $11,500, and the most affordable home is down here somewhere around $6,500 a month. That assumes an 80% loan at the federal average rate for a 30-year fixed mortgage. You can do better than that by doing either adjustable, putting more money down, or having a relationship bank pricing for your bank that does the loan with you. Now we're looking at distributions. Distributions are 3 key indicators, give you an idea of what the market's doing over the whole width. We're starting off a year ago, which is this blue dotted dashed line down here. The current year is the purple blue dashed line, which is on the blue side of the blue line. So the market's cooler this year than it typically is, but this allows you to see the distribution. So you can come up and see the 75th percentile, which is the number I normally follow. Right now, it's taking those sellers somewhere around 26 days, it looks like, to sell. And last year at this time, it took 20 days. So we're taking almost a full year longer to sell the property this year this week than we did last year. And you can see the outliers, the amount of time it takes increases. But when you come down to the median, that's why it becomes important to pay attention to what data we're talking about. At the median a year ago, the number was 11 days maybe, and now it's at 12. Almost no difference on the median, but you have a whole week difference here at the 75th percentile. And that's just because for the first basically 10 days, the homes are held onto the marketplace, or up to about 10 days. Sellers and listing agents want time to get out there and look at the inventory. So very few sellers put the house on the market and have accept the first offer in the door like we used to do back when I first got into the industry. Now it's keep the house on the market for the first weekend, see what happens week after the first weekend. A lot of people like to get their home on the market early. That gives you more than a full week right there. What we're going to be doing on this slide is we're going to be stepping through, starting on the blue dashed line, stepping through roughly a month at a time, but that's going to be defined by 4 or 5 weeks. You can see we go October 11th, November 8th, December 13th. So this is a 5-week jump, and this is a 4-week jump. I try to keep it a monthly, but this weekly cycle is so significant, I ignore the calendar month, which so many people follow. And what you do is you step through and just watch the market change. So you can see the market slowing down. January 10th was the slowest of the marketplace. There's the peak of the marketplace, April 12th. And, I'm only looking at every 4 weeks. So the actual peaks and actual valleys weren't caught. Now you're on to weekly data, starting right here with the dashed lines. And then the solid lines are the most recent lines. And you can see there's a cool down. And now you can see the market heating up. And we're going to do one more jump right there to the current week. So the market for the last couple weeks has been improving. Again, there was a couple weeks of improvement, then it's plateau, a couple weeks of improvement. And the first improvement was basically back around Labor Day. Moving on, doing the same thing with ask price reductions. So now what you can do is you can see that 5% of the sellers are taking a price reduction equal to about 8.5% of their marketplace using the purple line. Up here, 15% of the sellers are taking a price reduction of 1.5% or greater. So it gives you some idea of the distribution. And basically, at 17.5% of the sellers, it's rare that more than 17.5%. Remember, these lines are going to be at the end of the year when the market's the coolest and the price reductions are the greatest. So yes, here you do have more than 17.5% of the time, but the vast majority you don't. And our best week ever here are the red dashed line stayed at 100% all the way down to less than 2.5% of the price reduction of any price reductions. And the reason I don't go to zero is to eliminate those typos, data entry errors by the listing agent where they put a property on the market for $100,000 instead of $1 million that I don't catch. Stepping through and looking at this, you can see the slowdown from this point to the end of the year. Again, January 10th was the bottom coming up, and that's going to be the peak, April 12th. Now you're slowing down again, and you're sort of in the summer plateau. So you can see now you're really not going to change much because the purple line's back up here. And what you're going to do is you're going to slow down because the dashed lines, see, now you're actually below, cooler than the purple line. And starting from there on, you're going to start improving back up. Basically, that long summer plateau where you're just fluctuating for many, many weeks. Now flipping over and looking at overbidding and keeping in mind here, whatever date the showing here, this is based on closings. The offers were basically negotiated 5 weeks ago. The major exception to that is at the peak of the marketplace when the market's aggressive, buyers want to come in and be as attractive as possible. So they jump through all kinds of hurdles to close their escrow in 3 weeks. When they don't sense that huge need to do that, they do a more leisurely 4 or 5 week close of escrow. So these numbers right now are probably delayed by 5 weeks. Stepping through, you can see the market slowing down. There's the bottom of the market again, January the 10th. Now the market's improving. There's the peak, April 12th. Actually, May 10th may have been up there too. And now you're in the summer plateau. This is a more stable index. So you're basically just settled down to soft landing versus overshooting and coming back up. There's a little improvement there, but very minor. It basically is, soft landing comes down. And you can see all the lines are on top of one another, including the purple line, which is now showing here. The overbidding is blended out a little bit more. One, because the escrows close at different times, and also buyers are just, average it out a little bit. The inventory in Santa Clara County is in the blue, Alameda County in the gray, and San Mateo County in the orange. You can see that Santa Clara County has the biggest shortage. San Mateo County is almost back to the normal levels of inventory, and Alameda County and Santa Clara are typically fairly close together, as you can see from the past years. Now there's a huge separation. So Alameda County is closer, has more normal inventory than Santa Clara. All 3 counties are going up. All 3 counties have been basically going up since Labor Day. So the number of offers that we're having is increasing. Days unsold inventory, which is the speed of the marketplace. Santa Clara is the fastest marketplace. San Mateo is the second, and Alameda County is the slowest. And that's going to be interesting in a little bit, because even though Alameda County is the slowest county, you'll see that it's got the highest overbidding, which almost doesn't make sense. But look at the huge improvement. Because remember, days unsold inventory, the lower the number, the faster the marketplace. Look at the huge improvement all 3 counties has been making in the last 4 weeks. Here's your marketing time. How long is it taking 75% of the sellers to sell? Again, all 3 counties are in a downward direction. Alameda County is the slowest at a full 30 days. San Mateo County at about 25 days. And Santa Clara County, the fastest at 20 days. So Santa Clara County is only taking 2/3 the time that it takes to sell the property in Alameda County, yet Alameda County has the most aggressive overbidding. Here is the price reductions from the seller. Part of the reason that I think Alameda County stands out as an exception is they're doing more price reductions. It may not look like much here, but again, remember, this is everybody. So they're taking 1.1% price reduction, where in Santa Clara County, they're only taking 0.8%. So Alameda County is taking almost another third larger price reduction. Frequency of price reductions, Alameda County is by far the highest frequent price reductions. It's somewhere around 17.5% of the sellers taking price reductions, right at that threshold where I don't track it anymore. Then if you look at Santa Clara County, it's only at 14%, and San Mateo County is at about 14.5%. These may not sound like large differences, but again, when 85% of your sellers typically do no price reductions, it becomes pretty significant. Here's the overbidding. So here's where you can see that Alameda County is overbidding the most. It's 7% over the ask price, where San Mateo County and Santa Clara County are basically at 5.5%. You wouldn't expect that with the longer marketing time, but because the larger price reductions, I think what's happening in Alameda County is sellers are coming on the marketplace, they're missing the market, which gets their marketing time up, and then they do the price reduction and they overshoot where the buyers were willing to come in, because the buyers are very price sensitive, and therefore with the new price, they attract an overbidding situation, even though they've been on the market for a while. And that would explain the data. The frequency of overbidding, all three are very close together, with about 2/3 of the sellers getting more than their asking price. Yes, San Mateo County is a little bit lower than Santa Clara, but you're talking 64% versus 67%, very close together. Here's your long-term appreciation. Here, Santa Clara County shines with 100% appreciation, the original price plus 100%, so you've doubled your money. And typically, if you only put 20% down, you've now doubled the 100%. So your equity's gone from 20% to 120%. So you've done very well for yourself. And Alameda County is second, but San Mateo County is very close. They're at basically, call it 65% and about 68%. So very close together. 2/3 of the appreciation is still fairly good. And this is only since 2015. We got a reversal on pricing. Santa Clara County outshot San Mateo County this week on pricing. It's because San Mateo County did this fairly significant price decrease, while Santa Clara County did a price increase. Alameda County is flat, but all three are very similar to their price point in 2023. I would say the biggest exception is Santa Clara County is above their price point as their own price point in 2023. Here's the same information on regular paper. The previous was on log. You can see Santa Clara County is somewhere about 1,925,000, where San Mateo County is much closer to 1,900,000. Alameda County is down here at $1,250,000 for their median priced home. Here's those estimated payments are going to be in the same ratio. The payment is so close together you can't tell, but Santa Clara County would be slightly higher because they're going through the same mathematical formula. Now let's get into the heat maps. I've changed the order on this. If you haven't looked at me in the last week or two, basically I had the key at the top. I now bring in what the Silicon Valley, all three counties are. So you know that your inventory is essentially basically normal, 98.8% of the level of inventory you'd expect. Santa Clara County is at 91%, 91.5%. San Mateo is at 104%, so both sides are 100%. And Alameda County is at 96%. And the reason you can't just average those three numbers to get the Silicon Valley is San Mateo County is much smaller. And so this 104% doesn't carry as much weight. But you can see that you got one hot area in Santa Clara County, which is Campbell, Cambrian, Willow Glen, and Santa Clara at 70%. So they're missing 30% of the inventory. In San Mateo County, you have one area at Foster City, Redwood Shores, very small area. So you almost shouldn't be talking about it, with 18% more inventory than normal. And then an area of Pacifica, Daly City, South San Francisco, San Bruno, that actually has a shortage of inventory at only 73% of the inventory you normally do. For the first three maps, I only have Alameda County data. I don't have it broken down by the micro market areas. Same information here on offers. You can see the areas of blue are a little bit more widespread. So you have a shortage of offers, and you're seeing that with Silicon Valley being at 88% of where they normally are, Santa Clara County at 91% on both sides. Your high is 115%, so more offers in Cupertino, Sunnyvale, and your low is in the affordable areas, East, Central, and South San Jose at 74%. Sort of the same thing in San Mateo. Averages for the county is 95. The low is going to be in your expensive areas and the San Mateo County coast, the areas that has the least. But then the areas again that have the most is Foster City, again a very small one, so you shouldn't be really even paying attention to that. And that's why San Mateo as a whole is coming in at under 100% less inventory than you expect. And Alameda County, I don't have the data, so just 86% of the offers. So across the board, we're missing about 11.5% of the offers you'd expect to have. Speed of the market measured by days unsold inventory. You can Silicon Valley is basically 100% of normal, 98%. You can't get better than that. But Santa Clara County is at 93, so a little bit faster than normal. San Mateo County is at 111%, so clearly slower than normal. And Alameda County is at 102, just slightly slower than normal. Days sold inventory raw count, that was compared to normal, the normal being the previous 10 years. This is just the raw count. So this is sort of where the buyers are indicating. So even though the market's slower than it normally was, because of the blue in the previous slide, the buyers aren't going to feel that. They're going to feel a red hot marketplace because it's still moving quickly. If you look in Santa Clara County, a lot of your areas are moving in 26 days to 17 days. That's a fairly fast marketplace. That says you would sell everything out in those timeframes. It's a theoretical number because you're getting new inventory all the time, but it's your turnover rate. Here's your date marketing time. So this is a little bit more realistic. You can see a lot of the areas are selling out in under 18 days, which again is a fairly quick pace marketplace. For 75% of the sellers to sell before 3 weekends, that's pretty amazing. Here's your ask price reductions. So you can see pretty minor. San Mateo County is doing a little bit more price reductions. Even Pleasanton and Oakland are doing some price reductions. This is the frequency of price reductions. So again, fairly uncommon, which is why so much red. You can see the areas of Morgan Hill and East San Jose, the affordable areas in Santa Clara County are doing the most price reductions. In San Mateo County, it's sort of the reverse. The expensive areas and the coast are doing the most price reductions. Alameda County, it's going to be Pleasanton and Oakland doing the most price reductions. Here's the overbidding, the areas that the buyers feel the most pressure on. And you can see pretty much across the board, it's red. The only blue I'm seeing quickly is the expensive areas in Atherton, where they're coming in at 2% below the seller's ask price. The frequency of overbidding, only 31% of the sellers are getting overbid in Atherton, the expensive areas in San Mateo County. Most of these numbers are somewhere around 2/3 of the sellers are getting more than they're asking. Here's your long-term appreciation. You can see that most of the red is in Santa Clara County. Most of San Mateo County is in blue, and Alameda County is mostly in red. So the outlying areas are the areas that are getting the most appreciation. I believe that trend is related to the pandemic and the changes in buying preferences. One of the things I want to point out is, again, another apparent contradiction where you have 100% appreciation in Santa Clara County. But then if you look in areas 11 through 17, the areas within Santa Clara County, the highest area in there is 90% appreciation. And then after that, you're at 83% appreciation. So how can you have a county having 100% appreciation where basically each one of the micro market areas is below 90% and most of them are below 80%? Simply the market mix is shifted. All you have to do is have more activity in the areas that have above the median price property if we're Santa Clara County. So for example, if homes in Los Altos, Palo Alto, Saratoga, Los Gatos, Cupertino, Sunnyvale are selling at a higher rate than they normally did, then you would have a higher appreciation rate because you'd be pulling up the median for the whole county. That's why it's important to look and understand the data you're looking at. So you can have 100% appreciation like we do in Santa Clara County, but have none of the areas within Santa Clara County even really approaching that 100% appreciation. Here are your sold prices. Instead of following the median number, which is the middle number, I also follow the cheapest 10% in an area and the most expensive 90% in that area so that you get it sandwiched. So for example, in Santa Clara County, The cheapest you can expect to find a single family home is for 1.1 million. The typical home is 1.925, and the most expensive home is just under 4 million at 3.9. That way you can sandwich and get a better idea of what's going on. You can see the expensive areas are still central, right around the San Mateo, Santa Clara County border, as well as a little bit into San Mateo, with being the Bay Cities and Redwood City, as well as Foster City. And here the blue is not favoring the buyer, but just the more affordable areas, and the red are the more expensive areas and not favoring the seller. Here's a summary of all the different micro market areas. You can start off on the left-hand side with the micro market area that you're interested in and see the market conditions, or start over on the right-hand side with either the payment or the price range that you're looking in, and figure out what lines work for you, and then look across and see the market conditions, and then all the way over on the left what micro market areas those are. Here are the actual raw numbers. So you have them for Santa Clara County, San Mateo County, Alameda County, or Silicon Valley as a whole. Here is the number of low offers. This is actually improving quite a bit. We had been the worst or the second worst in the last 10 years. We're currently the second worst, but the more significant improvement is in the 25-year period. We had been the second worst for a long period of time, then the third worst. We're now the fourth worst. So we're actually pulling up and getting to be reasonable level of offers accepted, and they're no longer the worst you expect. With that, we've been talking about the Silicon Valley market. We will be talking about the Greater Bay Area, 13 counties, 5 regions next. If you want to look at any archive, you just use the blue URL for YouTube, or type in the shorter green root URL, which will take you to the same location. To join Saturday morning at 9 o'clock, just type in the green root URL in 2024. The handout is up and posted. You just add in the green root URL, H for handout 2024, 10/12 for the month and date. And you can look at any specific episode by using the green root URL, year, month, date code. I'm Richard Calhoun, broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. My contact information is there. I'd appreciate it if you haven't already subscribing, and then also like every video you watch. Moving on to the Greater Bay Area, Northern California, into 5 regions. The first is Silicon Valley, that we've already been talking about at length. Then we have the cities, which is San Francisco and Marin. Then North Bay, which is Sonoma, Napa, Solano, Contra Costa. Then San Joaquin and Sacramento being the Central Valley, and then the Central Coast being Santa Cruz and Monterey. Here is the slides. Silicon Valley is in the purple, North Bay is in the gray, Central Valley is in the yellow, Central Coast is in the blue, and the cities is in the orange. So you can see the orange and the Central Coast are the smallest, and therefore they have the least inventory. You can see that the Central Valley and the North Bay are almost at the same level as Silicon Valley, and historically they're a lot higher. So we know Silicon Valley is missing some inventory, but the missing inventory is much greater in the North Bay and the Central Valley. Moving on to offers, look at the turn up in 4 of the 5 regions: the cities, Central Valley, the North Bay, and the Silicon Valley. The only region that really hasn't ticked up significantly is the Central Coast, and it hasn't even come up a little bit. But all 3 of the biggest regions are going up significantly in the number of offers accepted. Here's your days on inventory, the turnover rate, and sort of the speed of the marketplace. This is a theoretical number because you'll always have new listings coming on the market. You can see Silicon Valley. Well, the first thing is notice that all 5 regions are going down fairly significantly. So that's an indication that the market's improving in all 5 regions. Silicon Valley is the fastest at 40 days. And then the slowest is the Central Coast at basically 80 days. And the other 3 are basically tied right around 60 days. Now we're looking at the easiest to understand metric, which is simply how long it takes 3/4 of the sellers to sell their property. You can see the Central Coast is the longest at 60 days, which is 2 months. North Bay is next at about 53 days. Central Valley is third in the middle at about 44 days. Then you have the cities coming in at about 36 days. And the fastest area is Silicon Valley at somewhere around 25 days for 3/4 of the sellers to sell. So that's less than 4 weeks. And again, notice that there's a huge improvement in the cities, Silicon Valley and North Bay. Central Coast and the Central Valley are going up or flat. Here's the seller's average ask price, and this is including everybody, and that's why the numbers are so low. Silicon Valley is at 0.9%, less than 1% of a price reduction. Central Valley is second at about 1.5% price reductions. North Bay is about 1.7, Cities is about 1.8, and the area that's having the most price reductions is the Central Coast at 2.6. And that's averaged, including those that aren't doing any price reduction, which is obviously the bulk of the sellers. Here's the frequency of the price reductions, and you can see that the most frequent areas are the Central Valley and the Central Coast, where roughly 35% of the sellers are doing price reductions. So right there, 2/3 of the sellers are not doing any price reductions. The North Bay is at about 29%, Cities is at 20%, and the Silicon Valley is all the way down at only about 15.5% of the sellers are doing a price reduction. This is the overbidding. So now we're leaving the seller and looking at the buyer. What are buyers doing? They're overbidding the most in the cities, where they're coming in at 7% over ask price. And this is average, not median on this graph. The Silicon Valley is at about 6%. The North Bay is all the way down at just half of 1% over ask price. Central Valley has crossed over and now is below the seller's ask price at about 0.25% of a price reduction. And the Central Coast is off at about 1.5% below the seller's ask price. It's amazing on how many buyers wait for the sellers to reduce their price and then come in with an offer versus offering them below the seller's ask price. Here's the frequency of those overbidding. You can see it's most common in Silicon Valley with about 66% of the buyers overbidding when they come in with their offer. The Cities is at second at 59%. Then you jump down to the North Bay at 42%, the Central Valley at 38%, and the Central Coast at only 34, or just over 1/3 of the buyers overbid. Here's the total appreciation. And again, you can see Silicon Valley as a whole, which includes all 3 counties, is at somewhere around 83% appreciation. The appreciation, we can see Central Valley has the most appreciation, about 93% appreciation since 2015, followed by Silicon Valley at about 83%. Then you jump down to Central Coast at 73% appreciation, then the North Bay at 64%. And finally, we have the cities coming in at only 42% appreciation since 2015. And you can really see how it's leveled off. And you can see the fall down here in 2022 was far greater than in any of the other regions. Here's the median sold price. The cities is actually the most expensive right at the moment, followed by Silicon Valley, followed by the Central Coast, then North Bay, and the most affordable area at just about $570,000 is the Central Valley. Here's your monthly payments. You can see that the San Mateo, the cities and the Silicon Valley are very close together. Central Coast is in the middle, followed by North Bay, and the most affordable is the Central Valley with monthly mortgage payments of just about $4,000 a month. Here are the actual numbers for anybody who wants to look at them. You can see that the Silicon Valley is just under 1.6 million, and the cities and Marin are going to be over 1.650. So that's why Marin and San Francisco, the cities, is more expensive. I don't have the regions on here. I'll see if I can squeeze them on, but I don't think I have room. I do have Silicon Valley, since that's the focus of the presentation. I also have the Bay Area, only because it's so important in the eyes of the media. The media always reports on what's going on in the Bay Area real estate market, and to me, it's a garbage number. With that, we've finished up our presentation. I'm not seeing any unmuted mics. Take care. Bye. See you next week. Thanks for listening.